Hey everyone, me Kevin here. Welcome back to another video. Today, actually just in a couple minutes, we are going to be going through the minute meeting notes. And this mic is all messed up, but don't sue me, bro. See, I got the don't sue me, bro shirt on. Anyway, we are going to be reviewing the Fed's minute meeting notes. We expect the market to pretty much not react. We're not really expecting any kind of surprise, but it's all going to come down to what is said about the possibility of interest rates going up in the future, which would probably manifest itself in some form of talk about tapering bond purchases at the Fed. They stop buying $120 billion a month in bonds. People might think, oh my gosh, maybe that's a prelude to interest rates coming down in the future, interest rates getting raised sooner than we expected. And so these notes come out in about 3 minutes, 2.5 to 3 minutes. So we're going to go through these. I've got a few resources up as well, just because some of the news organizations, what they get is they get access to these minutes before I do. I get them right on the minute at 11. But I think CNBC might get them 30 minutes prior. And then they get to kind of like put together their report, and it's called embargoed until right at 11. So obviously I'll have CNBC up ready to go as well. And then we'll see what the minutes say. But I'm going to be pulling them up in the next 2 minutes as well. Again, we're not really expecting a big shift here from the Fed. Everything should be chill. Everything should be okay. We're not expecting anything crazy, but you just never know. And it's definitely for the market. Obviously, the market's, it's some parts of the market are good, some are bad today. And I feel like that's something we could say every day, but I disagree. This has really been one of those days where it's just like Square holds up really nicely at 4%. And SOS is booming off the Reddit posts, but everything else seems to be heavily selling off. The autos are selling off. All the EVs are selling off. We've got recovery stocks selling off a bit today, but then again, really only like 1-2% across a lot of these, 0.5% for some of these. So we'll see how things go. Later today, and we do have some of the recoveries are up a little bit, about 0.5% to 0.25%. So it's a mixed market, right? This could mess it all up. We'll see. Later today, by the way, I'll also be having an interview with the CEO of MP Materials. So stay tuned for that. If you're a course member, make sure to leave your comments in the course. And remember to get yourself 2 free stocks with Webull. Deposit $100 and get 2 free stocks worth up to $1,850. All right. So any second now, we should be having this release. It looks like we're about 20 seconds away from 11 o'clock. Usually they're like smack dab on time here. So we'll see what these minutes say. We've got CNBC up as well in case they break to it first, which again, because they probably had this embargoed, they have an unfair advantage. But that's fine. We'll watch it together. So I'm on the Fed right now. Let's see. No minutes yet. Nothing yet. All right, here we go. This is always gets exciting. All right, so don't tell me they already have it.
Tyler Matheson, the Fed minutes breaking right now. What were they thinking at their last meeting? What were they thinking? Steve Leisman is digging through that, and Georgia is on everyone.
Digging through that. They must already have it, because I don't have them yet. We'll find out in just a moment. I haven't seen them actually get published yet on their presser. So maybe they're just saying that. Maybe they too are like, refresh. We'll find it in a moment.
Well, now accept rent payments and more.
Got it. It's up now. Here we go. Okay, I got it. I will share this with you in just a moment. So what we're going to do to go through this fast is we're going to Command F this. Okay. So let's see. Do they already have the report on it? Because
there's always action somewhere. And today it's in those big mega cap tech.
No, I don't think they have it yet. So we'll come right back to them. So what we want to look at is inflation. So we're just going to Command F inflation this. Okay. So, all right, the U.S., the trend towards higher long-term yields observed in recent months accelerated over the intermediate period and far forward. Real rates based on Treasury inflation protected securities tips rose considerably. Market participants highlighted an improving economic, let's get the highlighter here, improving economic outlook bolstered by the passage of the American Rescue Plan. Let's see here, progress on vaccinations as underlying the increase in yields. So basically the improving market as a reason for increasing yields. Higher term premiums could reflect the outlook. Okay, let's go to more increased uncertainty for the outlook for long-term interest rates as well as technical factors may have also contributed. Treasury market functioned well over the past period, although measures of market liquidity deteriorated slightly at the end of Feb. Okay, let's go to another search of inflation here. Okay, consumer price inflation through January as measured by the 12-month change in price index for personal consumption remained well below 2%. Let's see. Are they reading this off yet?
Names, they've had great runs too. So these
No, they're still talking about stocks. PCE inflation was 1.5% over the 12 months ending in January. CPI was 1.3% over the same period. Okay, we already know these. Okay, here we go. Okay, measures of longer run inflation expectations were little changed on balance. That's what we're expecting. That's good. 3-year ahead measures of inflation expectations produced by the Fed Bank of New York were essentially unchanged. Also good. A staff index of common inflation expectations, which summarizes the co-movement of a wide variety of inflation expectation measures, was about the same level in the fourth quarter. Got it. Consumer spending appeared to be increasing in the first quarter at a pace considerably faster on balance than in the fourth quarter of last year. Okay, so more spending, but still low expectations of inflation. Okay, we're just looking for the words inflation right now. Inflation rebounded in many foreign economies. However, underlying inflation pressures remain subdued. The nominal treasury yield curve steepened markedly. Here, this is what we want to read. Largely because of increases in long-term yields, although measures of inflation compensation also increased further. Despite the spikes in equity market volatility early in the intermeeting period, basically the madness that we saw in mid-February and March, spurred by heavy trading concentrated in a few specific stocks and subsequent concerns over the rapid rise in longer-term rates, broad equity indices rose on net. Consistent with a stronger outlook. This is true, like the Dow and the S&P and things like that went up. Things were pretty stable, with the exception of like Tesla. They may as well just say it, but they won't. However, in contrast to recent months, most of the recent increase in longer-term treasury yields was accounted for by higher TIPS implied real yields. Market participants attributed this to rising longer yields, blah, blah, blah. On Feb 25, yields rose especially sharp. Yeah, this was the kind of the start of really the oopsies. Okay, we had a shock. Got it. Affect fund rates. Okay, they're suggesting improved market conditions for a reason for this. Let's keep going for another staff economic outlook. Let's see, are they hitting on this yet?
The reasons is because one thing from the data is painting a strong picture. The Fed's painting a bit of a different picture, and many investors are a bit nervous. But at the end of the day, who wins? The market wins.
They're still blabbing. They're not actually reading off any of this yet. Okay, incoming data on inflation were little above what the staff had expected. Got it. Okay. So in addition, inflation was forecast to be temporarily boosted this year by the expected emergence of some production bottlenecks and supply constraints. Following the transitory increase this year, inflation was projected to run a bit below 2% next year. There we go. Now they're doing their report.
The pace of recovery had picked up recently, and that was again when they met in March. They saw encouraging developments regarding the pandemic, particularly the vaccinations, and the vaccination rate was something that buoyed their view. The release of pent-up demand, they said, could boost consumption down the road. Home sales were seen as robust. That may be an understatement given the actual data. The economy, though, this is important, was far from achieving the Fed's employment goals. And they said that changes to policy should be based on outcomes, not forecasts. That's the Federal Reserve really reiterating this idea that the Fed has gotten rid of this notion of preemption and moving ahead of time for fear of future inflation, wanting to see much more the whites of the eyes of inflation and actual decline or return to.
Take a look at this line here really quick. Oops, this one right here. The staff viewed the risks of upside inflationary pressures as having increased since the previous forecast and now saw the risks to the inflation projection as balanced. So balanced to slightly up. Let's go back to this.
Much lower unemployment, much more gain as to the lost jobs in the pandemic, and not signaling any near-term change in policy. Tyler?
All right, Steve, thank you very much, and stay with us.
Yeah, we know no changes. Let's just keep looking at some of their verbiage here. Overall financing conditions remained accommodative. Participants noted the path of the economy would depend significantly on the course of the virus. This is old news. We already know that portion. This is interesting to me. This section right here. Why would they say this? The staff continued to see uncertainty surrounding the outlook as elevated. Uncertainty is elevated, got it. Moreover, the uncertain course of the pandemic, particularly the emergence of more contagious strains of COVID, was viewed as tilting the risks to the economic outlook to the downside. This is potentially, in my opinion, a way of the Fed saying, look, if in the event, these COVID strains go away, if the strains like these other strains go away, maybe that might be their door to say, oh, okay, well, those downside risks didn't happen. Let's raise rates, right? Possible. However, given the resilience of the economy in the face of earlier surge in COVID-19 cases, the downside risks to the economic outlook were seen as smaller than previous. So they're thinking, but even still, even with those variants, we think we're still going to be okay. The staff viewed the risks of upside inflationary pressures as having increased since the previous forecast and now saw the risk to inflation projection as balanced. This is such an interesting phrase to me. They speak in tongues sometimes, but really it sounds like at this last meeting, there were some people at the Fed who legitimately said at the board meeting, who legitimately said, hey, look, it does look like there are some risks of upside inflationary pressures. Now, they didn't say temporary or short term here or long term, right? Just that that inflationary pressures have gone up. Some board members now think inflation might come sooner. And maybe because of their new projections, they're like, okay, well, we're kind of balanced. We got some people think it's going to be higher. Some people think it's going to be lower. But it definitely came up, this talk about higher inflation. Participants observed that household spending had risen notably so far this year and anticipated further gains in consumer spending would contribute significantly to the economic recovery, while household spending on services that typically require close personal contact remained weak. Okay, let's see. Participants anticipated consumer spending would be bolstered by the recently implemented stimulus packages here. With respect to the business sector, participants observed that business equipment investment had continued to increase. Got it. Headline inflation continued to remain below. In the near term, 12-month, inflation here is expected to move above 2%. Wait, hold on a second. In the near term, the 12-month change. Oh, okay. So in the next few months, that 12-month change in inflation is expected to go above 2%. But we already know that as we compare to the pit of last year. Transitory effects. After the transitory effects of these factors fade, however, participants generally anticipated that annual inflation readings would edge down next year. Look at that. That's actually interesting. I haven't seen them indicate when they would think inflation would go down again. They're saying next year. Subsequently, participants expected that inflation would likely move along a trajectory consistent with achieving the committee's objectives over time. Participants discussed market and survey-based measures of long-term inflation expectations, implications for the inflation outlook, market-based measures of inflation compensation, blah, 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 blah. Okay. A number of our participants indicated that increases in market-based measures of inflation compensation from last spring were consistent with the view that inflation was likely to move along a path over time consistent with the committee's goals. That's interesting. So here they're basically saying, hey, look, even though the market thinks inflation is going to be higher, we kind of predicted that the market would think inflation would go higher because that's going along our plan. We think inflation is going to go up as well, but we think it's going to be temporary. They're not changing their tune at all. They're actually remaining incredibly resilient here, suggesting that, hey, look, we're good. We're balanced here. We definitely see these short-term supply chain issues causing problems, but we don't believe that longer run inflation is going to be an issue. And the market pricing in higher inflation is actually right along the lines of what we would expect the market to do. Okay, in regards to action, let's see, overall financial. Okay, this is the same. Let's see here regarding action. Action would depend. We'll monitor it. Committed to using full range of tools. We know that. That's old news. Okay, they want to let inflation run hot over 2%, but they still haven't achieved 2%. Let's see. Okay, here, this asset purchases. Federal Reserve continued. We know that they continue to, but here, they judged that these asset purchases, this is that $120 billion in bonds. That's that big thing about bond tapering, right? These asset purchases would help foster smooth market functioning and accommodative financial conditions, thereby supporting the flow of credit to households and businesses. Members agreed that they would continue to monitor. So nothing here, no signs of changes. Appropriate stance. Okay, let's see. No real changes here. Some of the verbiage changed a little bit. Let's see. Members also determined oil prices having essentially retraced. It was appropriate to remove the reference to oil prices as a factor holding down oil, consumer price inflation, and simply state that inflation continues to run below 2%. Right at the conclusion. Okay, and then of course we got the no rate increase. This was the statement they approved, and nobody voted against these opinions. So they're all on board with essentially no indications here of bond tapering. They believe that we're going to run hot with inflation. This is new. I have not seen this phrase next year before, that inflation readings would edge down next year. That's interesting. So they're basically saying we could have these higher inflation expectations and the market pricing in this kind of volatility over the next year. I thought maybe, through August was my expectation. The Fed's actually thinking it's going to be until next year before we see inflation tick down. That's a big shift. And I'm going to have to really think about that one, because I was thinking we'll start seeing inflation edge down, solidly in August, September, 6 months sort of, towards October. But they're thinking it could be until next year. And this right here, with the staff viewing the risks of upside inflationary pressures as having increased, I believe being a reference to temporary inflation. That would be consistent with their message here. So that's a really, really quick overview, 13-minute overview here of what just came out in this Fed meeting, or the minutes of the meeting from March 16th to 17th, which was really following the bond crisis and yield crisis that we had. Let's quickly look at the 10-year chart here just to see how the market is responding to this, because this can be a market catalyst. So let's look at the 10-year really quick just to see how the market's reacting. Let's go to the 3-day. Okay, yeah, I mean, barely moving here. I'm going to hide myself for a second here. It had a temporary little peak there when this letter first came out. Let me go to the 1-day here really quick. Look at that temporary peak here. But I mean, this is nothing. The market's basically, this little peak here could be from the Fed saying like, hey, we definitely saw some inflation pressures going up. But I don't think this is any kind of big negative reaction. No bad news here. The only big change that I think out of this, that came out of this here, is that inflation might not edge down until next year. And that is it. That is a shift. That's definitely a shift from prior minute meetings notes. So anyway, oh, look, I'm here twice. There you have the update on the minute meeting notes. I'm going to jump on over into covering Biden now. So let's go ahead and jump over to Biden. It's going to be another live stream. So I'm going to end this, click the button, join me over there. I'm going to go live in like 10 seconds. See you there.